Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants, and also the author of the books on the tax-free cash growth warehouse strategy. This is a special report today, and it's about avoiding higher taxes in retirement. You see, there's a belief that results in complacency and inactivity, and that belief is, I'll be in a lower tax bracket when I retire, so I won't have to pay that much income tax. Yeah, but that may or may not be true. You see, it is possible that you'll be in a lower income tax bracket after you retire and you no longer have the income you generated in your career, but that doesn't necessarily mean that you'll have a lower income tax bill. In fact, just because you don't have the same total income that you had when working full-time in your career doesn't mean that you'll drop down to the next lower tax bracket. If the sum total of your retirement income, including pensions, if you have one, retirement accounts, Social Security, whatever else, if all of that is equal to 70% of what your working income was, there's a very good chance that you'll remain in the same income tax bracket as you were before you retired. Well, think about that. What does that mean? If you have 30% less income and have the same tax percentage of tax liability, how will that affect your lifestyle? The problem is, well, now I don't want to be negative. I like to have a positive outlook always, but it's important also to be realistic at the same time. And I'm sure you don't need to be reminded of all the craziness going on around the world. The economy, major sectors is in total shambles. Whole governments are collapsing under failing economies, and the entire world feels the effects. Now, here in the United States, by most accounts, the national debt has gotten completely out of control. The Fed's solution? Print more money. That creates expanding inflation, which can result in recession. And we've experienced a few episodes of that in recent decades, right? And in any case, in a very short time, our dollars won't buy near as much as they do now. So for the past several years, we've enjoyed the lowest income tax rates since the first couple decades when permanent income tax was imposed back in 1913. Now, it may be hard to believe, but when income tax reached its peak in the 1970s, it was as high as 75%. The highest bracket today is just about half that at 39%. Those of us who have been watching the economy and the national debt have seen the writing on the wall for a number of years now. Taxes are on the rise. We see it starting right now with higher tax brackets, but with the national debt as high as it is and the economy as unstable as it is, there simply is no alternative other than to raise taxes all across the board. Well, what can you and I do? Well, here's the solution. We need to find a secure and protected means of growing our money tax deferred or tax free, and in a way that we can tap into it in retirement without paying any income tax on it. Ideally, that would be in some sort of savings vehicle that pays high interest, higher than the inflation rate, is protected against loss or attachment, is liquid, so we can tap into it at will, and will not count against us if we need to qualify for Medicaid or some other kind of financial program that penalizes us for our assets. Enter the 7702 plan. The strategy. In the IRS code, there is a provision under Section 7702, and it constitutes the greatest benefit in the entire IRS tax code. It applies to cash value life insurance. Now, at this point, I feel it's necessary to make a distinction here before going any further. There is cash value life insurance, and then there is real cash value life insurance. I've come to truly understand this as I've made my way in the financial industry as a life insurance consultant. You see, universal life insurance is categorized as cash value and permanent. It can be, but generally is not. Now, don't get me wrong. I'm an independent broker, and I'm licensed to work with any and all life insurance providers in the United States. I was enticed into this particular field by the way indexed universal life was presented to me. At the time, I thought it was the greatest thing since chocolate cake. I love chocolate cake. 2 years and 4 agencies later, I discovered the truth about universal life. And it just ain't what it's cracked up to be. But this report isn't, this is not a class on life insurance. So I'm going to move past that. But with most whole life insurance, there is a cash value component that grows with compounding interest as you pay the premiums for the insurance. Because it's compounding, it really gets to snowballing after a number of years. The real beauty of this is, one, the interest rate is several times what banks pay to savings accounts, even higher than CDs and IRAs. Two, the growth is tax-free. And three, this asset is completely protected and secure. It's invisible to lawsuits, bankruptcies, and any programs that look at assets to qualify. It also grows guaranteed with no threat of loss. It's the perfect, safe savings vehicle. So here's the strategy for getting tax-free retirement income. All the money that you put into your policy is after-tax money. And that's a big reason why the IRS lets it grow tax-deferred. The money you pay as premiums for the policy is called cost basis. It's already been taxed, so it won't be taxed again. Unlike many other savings vehicles, especially qualified savings accounts, when you take money out of the cash value of your policy as withdrawals, or what is called surrenders in the industry, the first money that comes out is the first money that you put in it. It's called first in, first out, or FIFO, F-I-F-O. The significance of that is it was taxed before you put it in. So you can take it out without being taxed on it again at the higher tax rate that will no doubt be in effect when you want to take money out of your policy in retirement. So already this will be saving you from paying the higher income tax in retirement. Now, here's the secret sauce about the strategy. After you have exhausted the cost basis by taking free withdrawals from your policy's cash value, you now continue to take money tax-free income from your policy by taking policy loans against the remaining cash value. There is no tax on policy loans. And here's the kicker. You do not have to repay the loans. When you eventually die, any loan balance will be deducted from the tax-free death benefit that's paid out to your beneficiaries. So you don't need to be concerned about paying back the loans. And let's wrap this up. Now, undoubtedly, this is a new concept for you. And I want you to know that I'm here to help. If you already have a whole life policy, I'll be happy to review it with you and advise you on how to put it to work for you. Now, some providers are better than others, and especially when it comes to the attributes and design options that they offer. And that part gets a little complicated, so I'm not going to try to explain it all here. I will say this, though. Mutual companies that offer participating whole life are the best. And some offer design options that greatly accelerate the cash value growth. And I can help you with all these things as well. And don't worry, if you don't have the most optimal policy right now, there's a rule that allows you to exchange a policy for another one without losing any of the cash value you have in your current policy. It's called a 1035 exchange. Again, I'm happy to review your current policy with you or consult with you about getting a really good one started. You are not stuck here. I'm here to help. If you would like to talk with me, ask questions, find out what you can do, or if this strategy can work for you, please pick a time on my calendar and we'll have a conversation. Simple as that. No obligation, no charge, no pressure. To access my calendar, click on the link below in the description box. It's a calendly.com sc-fsic calendar. And that'll take you to my calendar and it'll show you what days are available. Pick a day, and then it'll show you what times are available. Pick a time. But when you do that, please be sure and fill in your name, email, and phone number. I look forward to talking with you. And again, we're here to help. All of our contact information is also in the description box below. If you like what you are learning here on this channel, please subscribe to the channel. Also, please leave your comments and questions here, and I will definitely get back to you or answer all of your questions, no question. And again, you can always email, call, text. We're available. We're here to help. So for now, aloha and mahalo for watching.